Paramount Global, known for its CBS television and news, Nickelodeon, and its movie studio, is considering buyout offers from Sony, Apollo Global Management, and Skydance Media. This comes following the company's April earnings report. Paramount saw a 6% rise in revenue to over $7 billion. But overshadowing this growth, the surprise removal of CEO Bob Bakish. He was reportedly ousted for not aggressively pursuing deals like selling its Showtime and BET channels, and for the slow rollout of streaming service Paramount Plus, moves that may have made Paramount more lucrative and less tied to legacy linear television. Media companies like Paramount face their biggest challenge yet, a decline in profitability from linear. People just aren't watching traditional television anymore. More commonly known as cable TV, it's no longer a powerhouse revenue driver because of the rate of cord cutting and the rapid rise of streaming and connected TV offerings.
The profitability center for a lot of these businesses was in the linear side of the business, and streaming certainly was not profitable at the start. It may be getting there, but they definitely put a lot of investment onto the streaming side before that profitability was able to show up.
That's Harry Brown, VP of Media Innovation at Tenuity, a full-funnel performance agency focusing on advertising data and measurement across TV and the internet. He says while streaming has proven to be wildly popular, subscribers aren't necessarily translating into revenue.
The faster than expected decline of linear is not being made up for by streaming is definitely accurate. And so I think one of the things that leads to is this trend towards consolidation that we're seeing among these legacy media providers. And that consolidation can be both M&A based. So we're seeing that with Paramount and, what was Skydance and now looks like Apollo and Sony. But we're also seeing that in terms of partnership.
This is a problem for media outlets, which once depended on a steady base of profits from linear programming. In 2027, TV advertising is projected to remain largely stagnant, while internet advertising is projected to grow by nearly 250% compared to 2018 revenue. This according to accounting firm PwC. The fallout from this decline in linear. Key streaming players are trying to woo consumers with more content in bigger bundles.
The way to achieve exit velocity as a streaming platform is in gathering audiences, and gathering audiences really comes down to consolidation of content and consolidation of quality content. One of the things that I think is driving these combinations of, like, say, Disney Plus, Hulu, and Max, which aren't combined into a single platform, but into a single offering, is because they have a competitive degree of content in aggregate that allows them to go up and compete against something like Netflix, which has one of the largest content libraries there is. It's pretty similar to the old linear cable model and getting your cable bundle. I think we're going to be seeing something quite similar to that in the next couple of years.
This return to bundling could also lead to more mega deals in the future.
Some of these JVs, I would expect at some point will become outright mergers. I expect we're going to see, in 5 years from now, I expect we're going to see a streaming landscape with fewer but larger players in it.
But Brown warns media companies may never reach the lofty highs they once enjoyed when linear television ruled.
To generate what linear used to be maybe 15 years ago, 20 years ago, I think that is unlikely. I think there is too much diversification in digital media outside of these businesses, not just in terms of streaming-only competitors like Netflix, but with platforms like TikTok, platforms like YouTube. I mean, there's just much more choice out there for viewers and for consumers to go beyond these traditional streaming platforms. YouTube and TikTok are one of the leading places for Gen Z to begin their search journey.
For Investors Business Daily, this is Mike Zhuang.